Enjoy your meeting.
All right. Good afternoon and welcome to our short presentation here at WorthPointe's Basic Investment Philosophy. I'm Christopher Van Slyke, joining you from Austin, Texas. I'm joined by Rick Wilkinson in Dallas.
Hello, I'm Rick Wilkinson, CFP in Bedford, Texas.
Oh, sorry.
Yeah.
To me, Dallas, Bedford, Fort Worth. I know, but that's not accurate.
Yeah.
He's in the metro. He's right in the middle. Anyway, today we're going to quickly run through about a 10-slide presentation of our basic investment philosophy. So I am going to load the slides now. And this presentation is called Pursuing a Better Investment Experience. The title is such because, the way investors experience owning investments through the market cycle is an important thing that we all struggle with and that we want to focus on here. We think that if you adopt our philosophy, that you'll have a better experience, not only better returns, but your life as someone who is an investor will be better. So slide one is called Embrace Market Pricing, and it's just giving you the statistics that every day in 2014 there were 60 million trades for $302 billion. And what that means is that thousands and thousands of investors all over the world were constantly evaluating what they believe to be fair market prices for the securities in the marketplace. And as it turns out, as we look at some of the statistics here in a minute, that mechanism for prices makes it very hard to beat the market by picking stocks or by timing the market. Do you have anything to add to that, Rick?
No, I think that the only thing that I could add is that information is processed so quickly now with the internet that if you have any information about a specific stock, the market has already probably priced that information into its current pricing. That's
what we're talking about. All right, slide two. Don't try and outguess the market. So if that theory is right, Rick, that you just mentioned, and that price information gets into prices so quickly that it's hard to outguess the market itself, here's the proof. So this concerns U.S. equity mutual funds for the last 15 years. There are 2,711 mutual funds in the database in that period in the U.S. And over that period, 19%, or 1 in 5, beat the market. Only 42% even survived the period. So it meant that over half were closed up for poor performance. And that's called survivorship bias, and a lot of people are unaware of that. And the reason is that markets are just brutally efficient at getting prices right. So even professional money managers have a tough time beating the market. Rick?
Christopher, I think that this is an excellent slide to demonstrate. I mean, if we were to try to go the other direction and try to outguess the market, then we only have a 1 in 5 chance to do that. And I think at WorthPointe, we're looking for things that are reliable and that will give us an indication or reliability that we will have success over the long haul. This is really going against the odds here when you only have a 1 in 5 chance of success.
Yeah, I'd rather be on the flip side of those odds and have the 80% chance of beating active managers, which those of us who don't try and employ these stock picking techniques enjoy. Next slide is called Resist Chasing Fast Performance. This is a big one. This happens to both individual investors and institutional investors, I might add. So big pension funds do the same thing. They tend to look backwards and see who did well last year or the year before and conclude that that's going to continue in the future. So using the same database of mutual funds that we looked at a minute ago, of the 2,711 during the first 10-year period, 25% of them beat the market. There's 682 funds. So if I were to conclude that that was a good way to pick funds or investments, then I'd put my money in there. And then if you look at the next 5 years, from 2010 to 2014, only 28% of those, basically a quarter of those, were able to beat the market. So what that tells me is that performance is pretty random, and past performance doesn't help you beat the market in the future. What do you think, Rick?
Not at all. And this is another example of, we try to focus on things, Christopher, that we can incorporate. That's, again, I mentioned this before about that reliability. We want to take as much, we want to stack the deck as much as we can in our clients' favors, and this 28% chance of beating, of outperformance does not always persist in the future.
Yeah, fair. In fact, it doesn't persist at all. A quarter, if 25% of them outperform in the future, that's akin with, that means a quarter of them badly underperform.
Yeah.
So past performance isn't going to help you. The next slide, really, it just says so many things, but what I like it to say is that simply diversifying, controlling your expenses and taxing, and letting markets work for you is a great way to grow money. So this shows what happened to $1 invested just before the Great Depression. So it's got the Great Depression, the Second World War, the Korean War, the dot-com bust, the '08 bust. It shows what happened to $1. So $1 in small U.S. stocks grew to $21,000. Which is just an astounding number, and that's with no manipulation whatsoever. That's just diversifying and holding it. And most people are just unaware that you can grow money like that with a simple strategy. Rick?
Well, and that's true, and I think it was a great point that you made. There was a lot of bad things that happened in the world during those periods of years, and yet through that, capital markets worked. And one of the things that had to happen, if you were an investor, you had to be present. You had to be in the market to get those type of returns.
That's an important point. The big returns come in very short periods. So if I were to look at, that's over an 80-year period, but most of the positive returns came in a very small percentage of months during that period. And if you try and time it by jumping in and out, you're likely to miss those big months. So you got to be there to get these returns. That's a great point, Rick. So what does matter in returns? So we know that you can't use past performance, and we know that stock picking doesn't help. There are actually, when you look at the academic research, there are 6 things that help, 4 in equities and 2 in fixed income, that will tell you how you can expect your portfolio to perform in the future. On the stock side, it's exposure to the market itself, which you hear called beta all the time. How big are the companies in the portfolio? How cheap are the companies in the portfolio? How profitable are they? And on the bond side, it's term. That is, these 10-year bonds or 20-year bonds or very short-term bonds, and credit. Are they junk bonds or are they T-bills? Those 6 factors, pulling the levers in your portfolio for those 6 factors is actually what's going to drive your returns in the long run. And that's what we focus on, and that's what we think all investors should focus on as they're building portfolios.
I agree, Christopher. And the thing that's neat about this is that when you focus on these things, you can actually control cost, which is a great component or a great factor that determines your rate of return.
Cost and taxes are important. We'll see that at the end when we talk about focusing on things we can control. Slide 6, simple slide. It's just about diversification. So a lot of people have U.S.-oriented portfolios, or they'll own the S&P 500. That's one country and 500 stocks. A global portfolio, like we would advocate, 46 countries and 8,600 stocks. I like people to think about the recent crisis in Greece. When that began, I got a lot of calls from the media and clients concerned about that. But when I reminded them that they had 46 countries and 8,600 or more securities in their portfolio, that put the power of diversification under the lens, and they quickly understood why that's important to do. So I love this slide, and I do think I regularly see people under-diversified.
That's true, and that diversification really played out well in the decade between 2000 and 2010. The media referred to that decade as the lost decade for stocks, because if you were to invest in the S&P 500 for that period of years, you'd have been slightly negative. But a globally diversified portfolio, similar to what we do at WorthPointe, would have returned roughly a 7% annualized rate of return. So a huge benefit there of global diversification.
That's a great point, Rick. All right, slide 7, market timing. So we're regularly asked the question, what's going to happen with stocks, what's going to happen with bonds, what's going to happen with Greece, what's going to happen with real estate? And the answer is that we don't know, and no one can know. This takes the same 15-year period, and year by year, it ranks the various asset classes, U.S. stocks, foreign stocks, emerging markets, bonds. It ranks them in order of which it had the best performance in any given year. And you can see that as you look across the years that the order trades off, and in fact this looks fairly random. And in fact, future prices are random and impossible to predict. So our philosophy says, hey, rather than trying to guess which is going to be the winner next year, own them all. And in fact, after one has a really good year, trim that one back and reallocate the money into the square at the bottom that had the poorest year, so you're systematically selling high and buying low.
I agree, and Christopher, you kind of relate this to agriculture. If you're a farmer and you had just one large section to plant your crops, you're determined of the weather, disease, the growing conditions, that sort of thing. But if you could go in, instead of having a huge position, you go in and you have, okay, I'm going to have a farm here in Texas or farm somewhere else overseas or somewhere else in the U.S., then you've got this ability here to always have a crop come in somewhere.
That's a great point. It's the real life examples that help me understand this stuff. Yeah. Slide 8, managing your emotions. So, what every human being does is, that would include professionals, because I see institutions doing this, is that they let their emotions, fear and greed, drive their decision making. Now, we've seen before on the previous slide that $1 grew to $21,000 in small U.S. companies. Very few people were able to grow their money that way, because when prices get high, they want to give up on the idea of diversification. They want to concentrate their portfolio in those assets that have risen. And when prices get low, they want to sell the assets with the most potential, that is the ones that have fallen the most, and run the other direction. And this cycle, in my opinion, more than any other cycle, destroys the long-term returns of investors.
That's true, Christopher. I mean, when the market goes up, a lot of times it looks like it's going to go up forever. And so investors are predisposed to buy at that point. And then when it's going down, it's looking like it's going to go down forever, and you're going to auger in the dirt, and that's when they want to sell, when it's at the low. Reality is that we have close to 12,000 stocks in our portfolio. And when the market's at high, we own 12,000 securities. When the market's at a low, we still own those same 12,000 securities. We haven't lost any ownership of what we have.
Well, and that kind of information and perspective is what's required to manage your emotions. So if you're working with an advisor, that's the advisor's job, is to help put things in perspective, just like Rick just did. Slide number 9, looking beyond the headlines. This is another, this sort of builds on slide 8. One of the reasons investors have so much trouble managing their emotions is the headlines. If you think about it, if CNN or the business channels ran a headline that says, hey, long-term buy and hold still works, well, no one would tune in. So they're going to focus on, the latest financial crisis, the latest scandal, to keep people watching it. And so people that are trying to control their emotions and manage their portfolios are getting false signals from the media. And it's very important really to disregard that and maintain your discipline according to your plan.
Christopher, I think it's important to keep in mind what the role of the media is. I mean, they're not really trying to dispense investment advice. What they're trying to do is gain advertising revenue. So the more they can increase viewership, the more they can increase advertising revenue. And nothing attracts viewership like car wrecks. So,
well said.
They will make it sound like the world's coming to an end because people will tune into that.
That's well said, and that goes for print as well. So, Money Magazine's job is not to help you invest money; it's to get you to pick up that magazine off the shelf and go buy it. So that's a different objective. Just keep that in mind. This is the enemy of managing your emotions and staying disciplined as an investor. So we like to focus on what you can control. You can't control the latest market cycle, and you can't beat the market by picking stocks. What you can control is to have a plan for how you want your investments to work over time. You can control the 6 factors that we mentioned before: size, value, profitability, exposure to the market, the term on your bonds, and the credit quality of the bonds. Those levers you can control in your portfolio. You're in control of diversification. You want to own 50 stocks or you want to own 10,000. You can drive that process to protect yourself. Keeping an eye on expenses and turnover. That's the other enemy of investor returns. Those are things you can control. And minimizing taxes. So keeping an eye on how the tax system works and how various movement within your portfolio is going to affect what you get to keep after taxes are all important. So that concludes the presentation. So Rick and I are going to come back on screen now and say goodbye. Rick, are you finding your...
I am. The meeting's locked, so I'm not able to.
Let me. Well, then you may not see Rick come back on screen, but he's there.
You may hear Rick, but Rick
you all,
there. It's just
you all saw his handsome face at the beginning. Anyway, I want to thank you very much for tuning in. If you'd like more information, our website is WorthPointe with an E, invest.com. There's a lot of good information there, or you can give us a call at 800-620-4232. Thank you very much.
Thank you.